Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the Deep Dive. Today, we're going to get into something really fundamental in the world of mergers and acquisitions.
Yeah, we're talking about payment structures, how these big deals actually get paid for.
Exactly. You see the headlines, right? Company A buys Company B. But, like, how? What's exchanged? Understanding that, well, it's not just for the finance pros out there. It gives you real insight into how value actually changes hands in business, whether it's a small local company being sold or these massive multi-billion-dollar takeovers.
It really does.
And for this deep dive, our information, our kind of groundwork, it comes from the Corporate Finance Institute, or CFI. They're a top-notch online provider for finance training, lots of practical stuff.
Right. Really solid source. And our mission for you listening in is basically to unpack the main ways these deals get done. We're talking cash, stock, or sometimes a mix of both.
Okay.
And we'll explore how picking one over the other really changes things, the risk, who owns what afterwards, and whether the deal actually creates value or, well, sometimes destroys it. Right.
Getting these differences, it's kind of a shortcut, really, to understanding what's really going on behind those big M&A announcements. Moves you past the headlines.
Okay, yeah, let's unpack that. So starting with maybe the one that seems simplest on the surface, cash offers.
Right, straight cash.
When a deal is just cash, CFI points out some pretty clear advantages. For the seller, the big one is immediate liquidity.
Yeah. Can't beat that sometimes.
Imagine you're selling your business, right? Getting that cash right away means, well, certainty. No ifs, ands, or buts.
Absolutely. No worrying if the buyer's stock price will tank later or anything like that. You get the money, end of story, it's clean.
And that certainty, it's really powerful, especially maybe for founders or, say, private equity firms who just want a clean exit. They can take that cash and do whatever they want next.
Exactly. Redeploy it, pay off investors, whatever. And CFI also mentions cash deals tend to close faster. Less hassle, less time for things to go wrong, which, everyone likes.
Faster is usually better in these things, usually. And from the buyer side, paying with cash means they don't dilute their existing shareholders' ownership.
Ah, right. They don't have to issue new stock.
Precisely. So current shareholders keep their same slice of the pie. No watering down their stake or potentially hurting earnings per share.
Okay, that dilution point is, that's pretty key.
Yeah.
So when does cash make the most sense? Like, when do companies lean this way?
Well, CFI's research suggests it's common when the buyer just has a lot of cash sitting around, obviously, or they can borrow easily.
Makes sense.
Yeah.
Got the money, use the money.
Right. But strategically, it's also often used when the buyer wants to keep things simple, minimize integration headaches.
Real.
Maybe they just want a specific piece of tech or a brand, not the whole operational mess. Cash makes that separation cleaner. You pay, you take the asset, done. Less entanglement.
So it's like a clean break. Avoids mixing cultures or dealing with, ongoing shareholder stuff from the seller's side.
Exactly. But, the flip side is if you need the seller's team or their expertise to stick around and stay motivated, maybe pure cash isn't the best for aligning incentives long term. It's a trade-off.
Right. Cash is certain, but maybe not always the best strategic fit if you're thinking long term together. Which leads us nicely into the alternative, stock-based consideration.
Yeah. Using the buyer's own shares as currency.
Yeah.
Fundamentally different.
Totally. So instead of cash, the seller gets shares in the acquiring company. And one big plus to the seller, CFI notes, is often taxes.
The tax angle.
Yeah, usually no immediate tax hit. You're not getting cash, you're getting an asset stock. So capital gains taxes typically wait until you actually sell those shares down the line.
That deferral can be huge. But what's really interesting, I think, is how stock aligns everyone.
How so?
Well, if the seller takes stock, they're now invested in the buyer's future success, right? Their payout depends on how well the combined company does.
So their interests are suddenly aligned.
Exactly. They want the buyer's stock price to go up. It also means the valuation risk is shared. If the stock pops after the deal, great for the seller. If it drops, well, they share that pain too.
Okay, shared risk, shared reward.
Precisely. And this is why you see it a lot in strategic mergers where they're counting on synergies. That idea, the combined company will be way better than the two parts separately.
Right, the 1 + 1 = 3 idea.
Sort of, yeah. And for the buyer, it lets them keep their cash for other things running the business, R&D, maybe another acquisition later. Super important for growth companies.
So the buyer is basically saying, hey, we believe in this combined future, and we want you, the seller, to believe in it too. Your payment is partly tied to making it happen.
That's a good way to put it. It directly motivates everyone, especially if key people from the seller's side are staying on board. Their payout grows if they help the whole thing succeed.
Makes sense. It turns it from just selling something to, investing together.
Yeah, it changes the whole vibe, but there's always a but. Well, the seller is now exposed to the market, right? If the buyer's stock tanks for whatever reason, maybe the market crashes, maybe the integration doesn't go well, the value of what the seller received goes down.
So they trade certainty for potential upside, but also potential downside.
Exactly. Depends on their confidence in the buyer, their own risk appetite. Big negotiation point, always.
Okay, so we have cash, certain, clean, maybe faster. Then stock aligns interests, conserves cash for the buyer, but adds risk for the seller. What about the middle ground?
Yes. The compromise. Mixed consideration.
Sounds like what it is.
Pretty much.
Yeah.
CFI highlights this as, a powerful compromise. You're using both cash and stock in the deal.
So part payment in cash, part in shares.
Exactly. It tries to capture the best of both worlds. For the seller, you get some cash up front, that immediate liquidity, that certainty piece we talked about.
Okay, reduces their immediate risk.
Right. But you also get stock, so you still have that potential upside if the combined company does well. You're still participating in the future growth.
So partial liquidity, partial future investment.
You got it. And connecting that to the bigger picture, it's a really flexible tool for managing risk on both sides. The seller isn't totally exposed to the stock's future, but they're not completely cashed out either.
And for the buyer?
Well, they don't have to use up all their cash, which is good. And they still get some of that valuable alignment with the seller because of the stock component.
Okay. So it helps if the buyer maybe doesn't have enough cash for an all-cash deal, but still wants to keep the seller engaged.
Precisely. Or maybe they want to balance providing some immediate concrete value with encouraging that long-term view. It's often about finding that sweet spot, that balance. You see it a lot in more complex or larger deals where balancing everyone's needs gets tricky.
Yeah, I can see that, especially maybe in that lower middle market space you sometimes hear about. Maybe the buyer isn't huge, doesn't have massive cash reserves, but they see real value and want the seller's team involved. A mixed deal makes it possible where maybe all cash wasn't feasible or all stock felt too risky for the seller. It's tailored.
Exactly. Tailored is the key word. It's not just picking option A, B, or C.
Okay, so we've got the main types: cash, stock, mixed. But you're saying it's not just about picking one. There are other things pushing and pulling on how that final structure looks.
Oh, absolutely. This is where it gets really interesting, as CFI points out. The how isn't decided in a vacuum. There's a whole bunch of factors shaping that final deal consideration.
Like what kind of factors are we talking about?
Well, first off, just the general market conditions. Think about interest rates.
Okay.
If interest rates are super high, borrowing money for a cash deal gets expensive. Right? So maybe stock or a mixed deal looks more attractive to the buyer. Low rates, maybe cash is easier.
Makes sense. The cost of money matters.
Big time. Then there's the buyer's own situation. How much debt do they already have? How stable is their stock price?
Yeah. If their stock price is bouncing around like crazy.
A seller might say, no thanks, give me cash.
Right.
Or at least more cash in the mix. But if the buyer's stock is solid, maybe perceived as undervalued even, then stock becomes a much more tempting currency for the seller.
Okay, so buyer's financial health and stock stability. What about the seller?
Huge factor. Their own preferences, their tax situation. It's critical.
Right. Like you said, maybe a founder's retiring and just wants the security of cash, period. Doesn't care about potential stock upside.
Exactly. Or maybe they really believe in the merger's potential and are young enough to ride it out, so they prefer stock for the growth and the tax deferral.
So it really depends on the specific people and companies involved.
Totally. Do they need to pay off their own debts right away? Do they have other plans for the money? It all feeds into the negotiation. CFI really drives home that each deal needs its own unique structure. It's this careful balancing act trying to meet strategic goals, financial constraints, and keep all the key stakeholders happy.
It's not arbitrary at all. It sounds like a very deliberate, very negotiated process.
Extremely deliberate, which is why CFI's final point on this is so potent. They basically say the form of consideration can make or break an M&A deal.
Wow. Make or break it.
Yeah, it's not just a side detail. It's fundamental to whether the deal actually works out for everyone involved or if it falls apart later.
Okay. So wrapping this up then, we've looked at the main ways deals get paid: cash, stock, and that hybrid mixed consideration. Each has its own pros, cons, implications for risk, for ownership.
Right. Liquidity versus alignment, certainty versus potential upside.
Exactly. And we saw it's not a simple choice. It's shaped by, well, everything from interest rates in the buyer's balance sheet to what the seller actually wants and needs out of the deal. It's a complex mix.
It really is. And maybe a final thought for you, the listener, to chew on.
Yeah.
Think about how knowing this stuff might change how you read the financial news. You see that company X bought company Y using, say, 60% cash and 40% stock.
Yeah.
Now, instead of just seeing the total price, you can start thinking, okay, why that specific mix? Maybe the buyer wanted to conserve some cash, but also needed to give the seller some confidence with upfront money. Maybe the seller really believes in the future, but needed some cash now.
You start reading between the lines.
Exactly. You could infer things about their strategies, their constraints, their confidence levels, the how of the payment. It often tells you just as much, maybe more, than the what's the final price tag. It really gets you thinking about the mechanics behind the headlines.
That's a really great takeaway. Look beyond the number, understand the structure. Fantastic point. Well, thank you for joining us on this deep dive into M&A payments. It's definitely valuable getting this kind of nuanced insight.
Glad to be here.
And thanks again to the Corporate Finance Institute for providing the groundwork for this discussion. Really appreciate their expertise. Until next time, everyone, keep digging deeper.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.